According to the Fin Health approach to personal finance, a key tenet of good financial health is that your investment wealth is held as tax effectively as possible, subject, of course, to staying within the law. It uses a tax effectiveness ratio as a proxy measure of your tax effectiveness. This ratio measures your household's superannuation holdings as a percentage of your projected lifetime investment wealth. It's suggested that exceeding a benchmark of 75% is desirable for good financial health. For most Australians, superannuation, or super, is the most tax-effective and simplest way to hold their investment wealth. Yet, constant tinkering by successive governments with the rules and regulations around superannuation has made the system increasingly complex and many wary of this investment environment. As a result, they only commit their minimum superannuation guarantee contributions to superannuation, rather than taking advantage of the avenues available to voluntarily add to their balances with surplus cash flow. Inevitably, these surplus funds are invested less tax effectively, reducing after-tax investment returns and investment wealth. In this video blog, we examine how tax rates affect investment returns and investment wealth accumulation, both in the accumulation and drawdown stages of an investor's life. The tax advantages of superannuation are clearly revealed. Hi, I'm John Lesky, retired personal financial advisor and founder of Fin Health, a guide to good financial health and your financial independence. To illustrate the impact of taxation on investment wealth, we'll use a standard set of assumptions, varying only the tax rate or tax environment to isolate its impact. The key investment assumptions used are as shown in this table. Total actual annual return is assumed to be 7% a year pre-tax, comprising an income return of 3.5% a year, implying a growth return of 3.38% per annum. Inflation, as measured by average weekly earnings, is assumed to be 2.5% a year, implying a real pre-tax total annual investment return of about 4.5% a year. An accumulation period of 35 years is initially examined, with a real $27,500 of earnings before tax, in today's dollars, invested each year under 4 tax arrangements. The $27,500 purposely corresponds with the current maximum sessional superannuation contributions, which are indexed annually with average weekly earnings. The 4 tax possibilities considered over the accumulation period are 1. 47% tax paid on both earnings and investment income, being the top income tax rate plus the Medicare levy under the income tax arrangements scheduled to commence from 1 July 2024, but currently under review. 2. 32% tax on earnings and investment income, the middle tax rate plus the Medicare levy. 3. 19% tax on earnings and investment income, the bottom tax rate. No Medicare levy is assumed to be paid, although it's unlikely that an investor able to invest $27,500 a year for 35 years would remain in this low tax bracket. And 4. Contribution of the real $27,500 of earnings to superannuation with a 15% tax rate on both contributions and superannuation investment income. The analysis doesn't take account of capital gains taxation, which is most favourable in the superannuation environment, nor does it take account of dividend franking. This chart shows how investment wealth grows in actual dollars over the 35 years of accumulation, based on the investment assumptions and indicated tax environments. Investment wealth is maximised in the superannuation environment, reflecting less tax paid on both earnings and investment income. It's almost double the investment wealth accumulated in the 47% tax environment. While only marginally better than the 19% situation, as discussed earlier, the investment income on the accumulation of a real $27,500 a year would, in reality, push the investor into a higher tax bracket. This next chart provides the same information in real dollars, that is, deflated for the assumed inflation rate of 2.5% a year. It reveals that, based on the assumptions, maximising concessional, that is, tax-deductible superannuation contributions, results in a superannuation end balance of almost $1.6 million, which, as we'll discuss, could be fully applied to the zero tax pension or drawdown phase of superannuation. Next, we'll have a look at how effectively each of these accumulated investment wealth balances fare in supporting an $80,000 a year inflation-adjusted spending aim over a 25-year drawdown or retirement phase. As it's assumed no exertion income is earned over this drawdown period, a 19% tax rate is applied to investment income earned outside of superannuation, regardless of the tax rate during the accumulation period. Again, no allowance is made for capital gains tax that in reality may become an issue as investments are sold to fund desired spending. Provided the investor is retired and over age 60, the full superannuation balance is able to be transferred to the zero tax pension phase. In this phase, pension payments made to fund desired spending are tax-free. Also, tax on both investment income and capital gains made on the investment balance supporting the pension payments is zero. While an inflation-adjusted limit of $1.7 million currently restricts how much can be placed in this tax-favourable environment, our investors' projected $1.55 million balance sits comfortably under this limit. This chart shows how the actual dollar investment balance for each tax environment supports the desired spending of a real $80,000 a year over a 25-year drawdown period. The investment balance accumulated in the 47% tax rate is exhausted within 14 years. In contrast, the investment balance held in superannuation continues to grow. Again, the chart now shown provides the same drawdown phase analysis as above, but in inflation-adjusted dollars. It reveals that the real investment balance held in the pension phase actually declines, but is still above $1 million after 25 years. In reality, minimum pension drawdown requirements would see this balance decline greater than shown, as the investor would almost certainly need to make pension payments in excess of desired spending. However, this excess would be available to invest outside superannuation. So, for most Australians, superannuation is a very tax-friendly environment for holding investments, both in the accumulation and drawdown stages of life. However, there are other factors to consider before committing all your investment wealth to superannuation. First, a key one is that it's difficult to access your funds prior to meeting a retirement condition. It therefore may be prudent to maintain a proportion of your investment wealth outside superannuation to meet unforeseen circumstances or to carry you across a period before you meet a retirement condition. Also, there's a nasty sting in the tail if you die with only non-dependents eligible to inherit your superannuation balance. A 15% tax would apply to the lump sum on the assumption it's all taxed, as would be the case for our example. It suggests the need to constantly review and manage this risk, particularly in the case of chronic ill health and/or with increasing age. However, despite some negatives, under current arrangements, superannuation is the most tax-effective environment to hold investment wealth. Don't let the constant tinkering and apparent complexity deter you from taking advantage of it. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally,